Hi there, everybody. I'm Ron DeLegge with ETFguide TV, and we've got the U.S. presidential election over and a potential vaccine for COVID-19. So how should you be positioning your investments? Here to talk with us about that and more is Lance McGray, head of ETFs at Advisors Asset Management. Lance, great to see you.
Thanks for having me, Ron. Always a pleasure to be with you.
So let's start by talking about the U.S. presidential election, which is at the top of many minds. It was a tightly contested race, and we've got Joe Biden as the president-elect. So if Democrats control the White House and the House of Representatives, while the Senate remains under control by Republicans, how do you think that's going to settle with financial markets?
Well, we certainly didn't experience the blue wave that many expected. And even with all the questions that are still surrounding the 2020 presidential election, it's interesting to note that the S&P 500 still posted its best election week performance going all the way back to 1932. With that said, we've potentially already seen a glimpse of what's to come. A split government may actually really be something that's really in demand by people, right? The stability and the checks and balances of a split government, might be something that the investors are really looking for and needing in 2021. And so why is that the case, right? I mean, on a very high level, it essentially means that the major changes, like that of the proposed corporate tax hike, which presidential-elect Biden is proposing, those may either be blocked or watered down going forward. But all in all, the market seems to like the idea of a Biden presidency along with a split government.
Let's shift now and talk about Pfizer, which appears to have a major breakthrough on the vaccine front with a coronavirus therapy solution that they say is 90% effective. So do you see market sentiment and business conditions improving?
Yeah, absolutely. I mean, first and foremost, putting the market sentiment aside, for a moment, this is great news for all of us. It's been a dark 10 or 11 months. And this news around the Pfizer vaccine really has sort of, shed some light at the end of the tunnel, which is great news. I think, unfortunately, the fact is we are still, experiencing a record number of COVID cases on a daily basis. We're still months away of getting this vaccine out to the masses. But with that said, we can see the light at the tunnel, and that is certainly a must for improving sentiment. Now, when you couple that news of the Pfizer vaccine with positive economic backdrops, which we've been experiencing, which includes better than expected Q3 earnings, an improving labor market, there's a lot of optimism going into 2021. And for that reason, market sentiment is clearly improving.
Yeah, that's a good sign. Now, let's talk about value stocks, which has been really a neglected area, as you know, compared to large cap growth stocks, which are the fan favorite. All the groupies love large cap growth stocks. But, the longer term results, we still can't negate the fact that value stocks longer term have been a good investment. And let's not forget some of the greatest investors in the world, people like Warren Buffett, have made billions by being value investors. So talk about that.
Yeah, this is very true. Value stocks have lagged their growth counterparts for a number of years now. But it's days like yesterday and today which help remind us why, you shouldn't ignore value stocks, especially when we can actually see the return of some sort of normalcy, and that's in sight. We've had several head fakes, in the growth versus value debate over the last few years. But you can't overlook, the broadening of participation that we experienced over the last few days. And, we tend to think that the vaccine news may be the catalyst that we need to get value and dividend stocks back in favor going forward.
Market timing is a tough thing to do. And a lot of investors are taking a look at U.S. markets, the stock markets at all-time highs. Meanwhile, yields at all-time lows and seemingly bottoming every time you look. And so what is the income investor to do in these uncertain times?
You mentioned a great point about market timing, right? And before we talk about the income question, let's take a step back and go back to the market timing, right? I mean, we talked value and growth and how challenging that has been, right, for especially value investors over the last 5 to 10 years. But it's so very important to talk about time in the market, right? We say it all the time at Advisors Asset Management. You miss a little, you miss a lot, right? And this speaks to the importance of being invested and avoiding the pitfalls associated with quote unquote market timing, right? And last week and a half has been a perfect example of this, right? We are in front of a lot of investors, a lot of individuals that have been on the sidelines in terms of cash. And they've been waiting for some clarity around the presidential election. When is the additional stimulus package coming? What's the update on the vaccine front? And unfortunately, those individuals just lost out on about over an 8% move in U.S. large caps over the last week and a half. So, it really is super important to talk about time in the market, not timing the market. Another way to look at this is, we have a chart here at AAM, which shows going back all the way to 1979, from a hypothetical $10,000 investment, say in the S&P 500, and if you invested that today, that would be close to, it'd be over $623,000. Now, if you missed out on the 10 best days over this 40-year period, your value, the $10,000 would have gone to only $289,000. So you would have essentially left $300,000 on the table, right? So the takeaway is, it's not necessarily just the one-day moves that you may miss if you're not in the market, but over the long run, the ability for those numbers to compound over time. And that's really the important message. Going back to your original question around yield and the search for income in this low rate environment, one area that we really think is sort of underutilized by many investors, especially those who are worried about stock valuations and those that are on the search for yield, is the preferred market. We launched the first low duration preferred ETF nearly a year ago, ticker PLFD. And that is an area that many investors have gravitated to over the last few months. Let's take a step back and talk about preferreds for a little while. What are they? Preferred stocks are, a hybrid security, which has, the traits of both, stocks and fixed income securities. Which is a really interesting type of security. Not only do they offer attractive yields compared to traditional fixed income asset classes, but they also offer a number of diversification benefits as well. And then on a side note, they really aren't highly correlated without those are stocks and bonds. Like most securities, there are a lot of risks associated with preferreds as well. The majors include credit risk and duration risk and call risk. Fortunately, PLFD's underlying risk, our underlying index, addresses both call risk and duration risk. So, to wrap this up, PLFD as of 10/31 had an SEC yield of 563 and a duration of 1.3. So in this environment, that is an extremely attractive combination. And again, preferred stocks and preferred securities is another avenue that income-seeking investors can explore to find that yield that they're looking for.
Yeah, that's a great tip. And I think, too, that's a sweet spot when you think about it between equities and bonds. It doesn't have to be one or the other, maybe a blend of both. So solid points on preferred securities and, of course, the way to play that with ETFs. Lance, great job. And it's always wonderful to catch up with you. And thank you always for your timely insights.
Thanks a lot, Ron. Have a great day.
You just heard from Lance McGray, head of ETFs at Advisors Asset Management. I'm Ron DeLegge with ETFguide TV. Be sure to subscribe to our channel. Also, post your thoughts below. Let us know how you've been enjoying the program. We'll catch you next time. Take care.